Budgetary Control, Chapter 3. And for some reason, I have to always click that twice. I can't tell you why.
For your chapters, do they match exactly the chapter in the book?
Yes.
Like you add extra?
Well, I add different things, but it's the subject matches per chapter.
I mean, you're not combining other chapters and calling it chapter 1 or chapter 2.
Well, I don't know. I don't want to say that there's not something that I might have thought of that could be conceived as a chapter 3 thing that I put in, but I'd say for the most part, yes. I've tried to stick with the outline of the book for the things that we're covering in the chapters, yeah. Okay, sometimes I'll see something that I want to say at this point that maybe the book doesn't stay till the next chapter or something, but for the most part, yes. Okay, so let's go ahead and let's take a look at budgetary control. Okay, and this is the part of this class that students sometimes feel like, wow, this is really different than anything I've studied before, because you may not have looked at how to do accounting for budgetary. You maybe prepared a budget in 101 or in accounting 101 or in 305 or something, but you probably did not have to do specific journal entries related to a budget. Governments have a standardized budget process, and because it is standardized, that means all governments do the same thing. It means it is something that we will study in this class, and it is something that is applicable to any government. It is something that is applicable to professional exams like the CPA exam, etc., when they test on governmental accounting. So we're going to spend some time with this. In this chapter, we're just going to quickly get a feel for it, and then we're going to dig into it more in the second half of chapter 4, chapter 4b, when we get to that next time. Okay, so we'll talk more about this later on, but I just want us to sort of get a little bit of acclimation to it here. Okay. So what happens? We have our funding, and our funding is for our various programs. Remember, we've talked quite a bit about public safety, for example, right? And when we have these programs, we have to live within our budgetary constraints. Now, we get funding that comes in through revenues, etc., like our taxes, but we also need the authority to spend those funds. Okay, so what we do is we develop a budget, and we develop the budget, and we estimate what our revenues are going to be. Okay, so we have our revenues, and when we have our revenues, we sit there and we estimate the revenues. We estimate those. Do we know what they actually are going to be? We don't know, because we don't know exactly how someone's going to report their taxes to us, right? Okay, but we're going to estimate our revenues. We're also going to have something called estimated other financing sources. Okay, did we talk about that in chapter 2 or not? Okay, all right. Well, you say no. Someone told me we start on a different page, but I guess we didn't talk about it. Okay, so let's go ahead and let's take a look then and see how estimated or how other financing sources will work. Okay, so when we have our other financing sources, let's see. Best way to do this, and since we didn't talk about it in chapter 2 apparently, is to go back to chapter 2. Chapter 2 slides. Okay, and let's just go ahead and look at this. Okay, and we have something called other financing sources and other financing uses. So what is this? Chapter 2, slide 38. Okay, other financing sources and uses. Got it? Okay. All right. So we have what? We have our other financing sources and uses, right? Okay. Now, other financing source, notice we have done what? We have grouped it with the revenues, and that name should indicate to you that it is what? It is a resource inflow, isn't it? Okay, it's a resource inflow because we've grouped it with the revenues. We take our expenditures and we put that with our other financing uses. Now, the way to think of an other financing source is like a non-operating revenue. And the way to think of an other financing use is like a non-operating expense, right? Now you say, well, John, why don't you just call them non-operating revenues and expenses? Because the nature of these things are such that they don't really fall into the category of revenue or expense. So we call them other financing what? Sources and uses, right? But they're non-operating items. Okay? So when we talk about our other financing sources, we say other financing sources mainly represent operating transfers in from other funds and proceeds from long-term debt. So we have what? How many other financing sources do we have? 2. Other financing uses mainly constitute what? Turn that into highlighter. Mainly constitute, and let's go back to yellow, mainly constitute what? Transfers out to other funds. So how many other financing uses do we have? Just the one, right? Okay, so there's one other financing use and 2 other financing sources, right? Hello? Okay. Okay, good. Now, what are some examples of what they're talking about here? Let's say I go ahead and I issue some long-term debt. Okay, let's say I issue some long-term debt. Actually, just go back to the other side. Let's say I issue some long-term debt. When I issue long-term debt, say in my capital project fund, do I receive cash? When I issue long-term debt, I receive cash, don't I? So what would I do? I would go ahead and debit cash, say for $1 million. And what am I going to credit? I'm going to credit other financing sources. You're feeling that. Look, I can't credit long-term debt because I don't have a long-term debt on there, do I? So I have to credit what? Other financing sources. And I might indicate on there that it's bond proceeds, whatever. But it's not a liability. It's another financing source. It's like a non-operating revenue, isn't it? With me so far? I debited cash. I credited other financing sources. Bond proceeds, $1 million. Debit cash, credit other financing sources, hyphen, bond proceeds, $1 million. Right? Okay. Okay, good. So there's my long-term borrowing. Let's say, remember the story of the capital project fund that had that $30,000 sitting there that it needed money for the environmental study, and I said the general fund was probably going to be the one that was going to send the money over? Remember that whole story? So when the general fund sends that money over, is it going to credit cash? Okay. don't destroy all your basic understanding of accounting. Okay. If I send money over, am I going to credit cash?
I had in my notes, you said other financing sources transferred.
Okay. When I spend money, do I credit cash? Okay. That's all I'm asking. So when I send the money over, I'm going to credit cash, right? Okay. So I go ahead and I credit cash for, what was it, $30,000 in that example? Remember that? It was $30,000 in that example? Okay. I credit cash and I have to do what? I have to debit something, don't I? And I debit OFU. And you're like, OFU, John, I want to go home. It's Friday. Okay. I debit other financing uses, what? Transfer out. This is the transfer out. This is the other financing use. And now I messed up. Is it terrible to be an accountant? I can't live with that debit and credit not being shown properly. Sometimes my accounting 100 students will want to write them right underneath each other, and I say, no, you have to write it over to the right. Okay, so what happens? We debit what? We debit other financing use. We credit the cash for the cash that's coming out. There's my other financing use. There's the transfer out, right? Is that the transfer out? Okay. Now, in the capital project fund, what's going to happen? Capital project fund is going to get some money, aren't they? So in the capital project fund, I'll try to squeeze them in here. Capital project fund, when you receive cash, do you debit it? Debit cash for $10,000. I have to credit something, don't I? I credit what? Other financing source. This is a transfer in, isn't it? And I would credit that for $10,000. Right? This is a transfer in. This is other financing source. I'll credit that for $10,000. Right? So the reason I wanted to go to the debit first, so that it's, for me, it's easier for my brain to think of the money being transferred out and then what being received on the other end. That's why I wanted to go to the transfer out first. But we have the what? We have the one transfer out, the one other financing use, I should say, which is what? The transfer out of the capital project fund. We have what? We have the transfer in, which is one of my two other financing sources, the money coming into the capital project fund, right? And, of course, we've said bond proceeds is a transfer in as well. So we have these two items that are like non-operating items. We call them what? Other financing sources, other financing uses. Other financing sources, there are two of them, transfers in and long-term debt proceeds. There's only one other financing use, which is what? The transfer out. So now the only question becomes, well, where do we report these non-operating type things? Okay, so just come over to our statement of revenues, expenditures, and change in fund balance, and you see that we have what? We have our revenues, like our taxes. We have our expenditures, right? For example, if we spend money on public safety, remember fire and police department help us to form public safety. We have what? We have our capital outlay. If we spend money on police cars, we're going to report that as an expenditure as well, aren't we? Okay. Now we get down here to this item called excess deficiency of revenues over expenditures. See that line item? I want you to go ahead and say that that one is like, L-I-K-E, like operating income. When you prepare your financial statements in commercial, using commercial accounting, don't you show your revenues minus your expenses or your operating item, your operating income? Right? So we're showing this number. We don't call it operating income. We call it excess of revenues over expenditures. But the revenue and expenditures are normal course of business things, getting taxes, doing what? Spending money on police cars, police salaries, etc., right? Okay? But then you get over to this next section of the statement of revenues, expenditures, and change in fund balance, and you start having other financing sources and uses, and those are sort of like what? Like non-operating, aren't they? Aren't those like non-operating? Okay, and what are they? Okay, proceeds from long-term debt, transfer in, those are the what? Other financing sources, aren't they? And then what? Then you come over and you have here the what? The other financing uses, and that's the transfer out, isn't it? Isn't that the transfer out? So the other financing sources and uses show up on what? Show up on the statement of revenues, expenditures, and change in fund balance, the operating statement, and they're like non-operating items, aren't they? Okay, so what's the whole takeaway from this discussion? We have other financing sources and uses. There are what? There are two other financing sources, bond proceeds and transfers in. They are reported on the statement of revenues, expenditures, and change in fund balance, aren't they? After our revenues and expenses. That's one takeaway. Other takeaway is what? There is one other financing use. It is transfer out. It is reported on the statement of revenues, expenditures, and change in fund balance after what? After our operating items, our revenues and expenses, right? Right? Okay, that's another takeaway. The other takeaway is that you need to know this line item right here is reported on the statement of revenues, expenditures, and change in fund balance, and it is the difference between my revenues and expenditures, isn't it? I promise you that on your exam, I will ask you what is the amount of excess / deficiency of revenues over expenditures, and I'll give you a listing of items, and you're going to have to know to call out what? Find the revenues and expenditure items that would have generated that, and you would, of course, ignore any other financing sources and uses that are listed there because they don't enter into that calculation, do they? Right? It's revenues minus expenditures. And then the other takeaway is, and this is maybe one of the more important takeaways from this whole class, is how revenues, expenditures, other financing sources and uses affect fund balance. Fund balance is like what? Retained earnings. Fund balance is like retained earnings. Therefore, revenues do what to fund balance? Increase it. Good. Expenditures do what to fund balance? Decrease it, right? Okay, good. Since other financing sources are like non-operating revenues, what do they do to fund balance? What do other financing sources do to fund balance? Increase. Good. What do other financing uses do to fund balance? Decrease. Good. Okay. It's important that you know that because you're going to be giving some questions where we're going to say, here's the other financing sources, here's the uses, here's the revenue, here's the expenditures. What's the ending balance and fund balance? You're going to have to be able to calculate all that, right? Okay. Question?
Roughly, how many questions is the midterm?
30, exactly. 30 multiple choice questions. I almost called it a task-based simulation. That's what they call them on the CPA exam. No full-blown type of problems. It's all multiple choice questions. Even though the CPA exam is going more to task-based simulation in the future and less multiple choice questions, we're going to stick with multiple choice questions in here because I don't want to die trying to correct everybody's paper and go through. And the first semester I taught here, I added Counting 100, and I made them do a worksheet where I gave them partial credit, like if they got the debit right but the credit wrong, I would give them a half a point for that. And so I said, oh, okay, yeah, I'll go through this. And I had like maybe 100 tests I had to create. I'll go through this in the weekend. By the Sunday night, I'm like, why did I do this? I was sitting there and I'm trying to figure out what's going on. So, and then a student told me that the worksheet was hard. They said the worksheet was really hard. And I said, well, what was hard about it? Well, we had to go up and down and across. And I'm like, well, this is an up and down or across world. I mean, how do you get anywhere unless you go up, down, or across? I mean, that's unless you're in a three-dimensional, unless you're going to enter another dimension that I don't know about. Okay, anyway. Okay, so it'll be 30 multiple choice questions, and they're going to be very similar to the quiz questions that we work, and the ones that I've interspaced between the slides, just like that. Chapter 3 and 4 on I Learn What? The video for it? There are no Chapter 3 questions, and the Chapter 4 questions I think I put up there yesterday. Huh? They're there now. I put the Chapter 4 questions yesterday. Yeah. Okay. And there are no Chapter 3, because Chapter 3 we're just going to get a taste, and then we'll get into it more in Chapter 4. Okay. Okay. So let me go ahead and I guess save this. No idea what I'm doing with it now. I think it's good to save. Oh, no. Okay, continue. Okay, lower that. I'll close that. Back to this. Meanwhile, back at Chapter 3, we were sitting here and we were talking about other financing sources and uses. 1 second, guys. What? Okay, so now we can come back and we can understand now that we have these budgetary accounts, and these budgetary accounts are going to be estimated amounts, okay? And they're going to be estimated for our revenues. Now, the government doesn't know exactly what its revenues are going to be, but they estimate that. They take the what? The estimated other financing sources. Any transfers in, they think they're going to have. Any bond proceeds, they're thinking of having, they estimate that. These are what? These are estimates before the year starts, right? Okay. Then what? Then they also estimate the other financing uses. Those are the amounts that they're going to be going out, that transfers out, right? Okay. Now, we also have appropriations. And I want you to put that these are like estimated expenditures, but don't call them that. They are not estimated expenditures, but you don't call them that, but they're like estimated expenditure. But don't call them estimated expenditure. That's wrong. We have to use a very specific term. It is called an appropriation. It is called an appropriation. What happens? A government cannot spend money unless it receives legal authority to spend that money, and that legal authority is called an appropriation. And if the government does not get an appropriation, it cannot spend money. If a city agency, city department does not receive an appropriation, that city cannot spend any money. Okay, so what happens? If we pay a guy to water the lawn at the park, but we don't pass an appropriation to pay that guy, will that guy water the lawn at the park? No, unless he's some sort of really dedicated person. And so what happens? We would just let the lawn die, wouldn't we? Okay, we cannot spend money unless we have the legal authority to do so. This is why a couple years ago they said they shut down the government, and they showed you shutting down all the parks and all that. The reason is that Congress, the Republicans and the Democrats, couldn't agree as to how they were going to spend the money, so they didn't pass an appropriation. So even though they had cash in their coffers, they got lots of cash, they couldn't spend any of it legally because what? Because they hadn't passed an appropriation to cover that year. The federal government is funded by 13 appropriation laws. Now look, they don't let the Canadians take over. They keep the army and stuff in place. They say, oh, okay, so if a city doesn't pass the appropriation, it's like, what's that movie? The Purge. Everyone goes crazy. You guys have seen that movie? Okay, there's that movie where everyone goes crazy and starts killing everybody else, whatever. It's not like it's like that at that point, because we'll keep essential services in place. We don't let the city burn down. But what? But they send non-essential personnel home. And in the federal government situation, they start playing politics with it. They say, oh, we're going to pass just enough appropriation so we can keep the parks open, the federal parks open, right? I mean, come on. That's just a political game. So you're going to pass an appropriation to keep the parks open, but you're going to, and the memorials of veterans, but you're going to let the veterans hospitals close down, right? Or the people that were actually alive, right? So they start playing political games with it. But the reason they do that is because what? Because they cannot spend money unless they have an appropriation. Okay? Now, once they get that appropriation, they can only spend the amount that the appropriation says they can spend, and they can only spend it on the things that the appropriation says they can spend it on, right? Thus, we have our funds that making sure that we're spending what? The correct amounts, and we're spending them on the correct things, right? Because they planned them to be in the red. They passed them knowing that there'll be a deficit. You think that's an oops?
But you said appropriation, you cannot spend over X amount.
So your budget is $1 million. Your revenue is going to be 800,000. Are you going to have a deficit?
Yes.
Can you spend $1 million?
Yes.
There you go, deficit. Okay, they plan it. They do it on purpose. They sit around and decide. So the deficit, we're going to have a, right? And everybody says, yeah, okay, yeah. You want to vote for that? Okay, yeah, I'll vote for that. I vote for the deficit. That's what they do. And they do it again, 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 until there's $17-19 trillion sitting there. And they vote in a deficit, and then they put a debt ceiling that says, well, we can't have a debt more than $18 trillion, but they pass and they vote for a deficit to take it over $19 trillion, and then they sit there in front of you and lie to your face and say, this is terrible. Who did this? Well, you did. You voted for it, didn't you? I mean, this politics is getting out of hand. Okay? All right, but that's basically what they do. Okay? So what happens? We sit here and we have these appropriations, but we can't spend more than our appropriation. That we know. And so what we do is we set up an encumbrance process that will allow us to make sure that we do not overspend our appropriation. And we balance this whole thing out with sort of a holding account, if you will, called budgetary control. Okay? These accounts that you see up here are our what? Are our budgetary accounts, and we're literally going to make journal entries into these accounts. And this is something that is a major takeaway from this class, that you understand how to make those budgetary entries. Okay? Okay, and again, we're just tasting it here. We're going to get into the detail of this in Chapter 4. All right? All right, so let's just come over and let's take a look, see how this works. And we have our journal entries for our budget. And guys, I'm showing you, this is the GL level. This is the subsidiary level. Easy for me to say. Right, so we have subsidiary, easy for me to spell too. We have subsidiary ledger, and we have what? We have the GL level. So what happens? These two amounts will roll. These amounts will roll up into that, right? I don't think I need to explain subsidiary versus GL to you, right? Okay. In this class, I am only interested in the GL level. I'm just showing you this here for this purpose, just so that you understand that there is a subsidiary ledger working underneath the GL. Okay, but we really talk at the general ledger level here in this class. Okay, and so what happens? This government looks around and it says, you know what, Bob? What, Al? That's Bob and Al talking. Okay, I think our revenue this year is going to be 500,000. What do you think? Yeah, that sounds right to me. 500,000 is what our revenue is going to be. So they estimate that, right? They may be a little more sophisticated than that, but that's the way they estimate that. And we debit estimated revenue. Okay? Now, what happens? Then the legislature gets involved and they pass an appropriation law that says, we hereby say that you can spend $450,000. Are we going to have any money left over? We're going to have some money left over, so they go ahead and they do what? They credit this account called budgetary control. It's a temporary holding place for the money that we think is going to be left over. The amount that's actually left over could be different, couldn't it? Particularly if what? If our revenues are more or less, right? Okay. Okay, so we have the revenue. We really can't control that as much as we can control the appropriations, the amount of legal spending that we have. Now, when we have a situation like this, we have what we call, what is this? This is a surplus, isn't it? Because this government's planning to have some money left over, right? Okay. Now, if I am doing a situation like this, where I debit my estimated revenue for 500,000, for 450,000, excuse me. I think you know where I'm going with this. And I credit my appropriation. I'm just going to abbreviate that for 500. That's 500,000. I credit that for 500,000, my appropriation. Do I need a debit or a credit to make this journal entry balance? I need a debit, right, of 50,000. We're not going to mess you up that much. I debit that 50,000. I will debit bud control, won't I? I'll debit bud control. And this is called what? This is called a deficit. Right? In the federal government, they do something like this. They debit estimated, you don't have to write this down, estimated revenue for 2 trillion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Is that 2 trillion? Yeah. Right? They debit estimated revenue for 2 trillion and they credit appropriation for 3 trillion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And do we need a debit or a credit to make this journal entry balance? We need a debit. 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Oops. Sometimes we, us government workers, just keep writing zeros at the end of the numbers. And that ends up being the budgetary control. Is that a deficit? That's a deficit of $1 trillion. And you do that for 30 or so years, and that's how you end up with, it wasn't always $1 trillion, it's grown, but that's how you end up with $19 trillion of debt eventually, right? Okay? So that's what goes on there. And then they sit there and they say, well, we can't raise taxes. We're not going to raise taxes. We're not going to cut anybody's Social Security. Don't worry. Vote for me. I won't touch your Social Security. Vote for me. I won't raise your taxes. I won't cut Social Security. I won't raise your taxes. I won't cut your program. I won't raise your taxes. And you make that many promises, and you end up with what? $19 trillion of debt. And then the public sits there and they blame the politicians and say, look what they did. Well, you voted for them. Okay? All right. So what happens? Did this government change my slide? They heard me talking and somebody said, change that slide. Okay? So you come over and we have a what? We have a surplus in the situation that they came up with here, don't we? Okay? Now, if we were a responsible government, we might try to end up with a surplus. We could have a deficit as well, though. But notice what's weird going on here. We are debiting revenue, aren't we? We're debiting revenue. Isn't that kind of weird to debit a revenue account? You're supposed to credit a revenue account, right? We're crediting accounts that are going to eventually represent our spending, aren't we? Isn't that kind of weird? We're going the opposite direction of what we're supposed to, aren't we? Okay? Why are we doing that? Well, you come over and we are looking at this, and I left on there subsidiary, but I'm still giving you GL level account, so probably should strike out subsidiary because it's just looking at this revenues ledger because I'm using the GL numbers now, right, to do this, right? And I did what? I debited estimated revenue, didn't I? And when I debited estimated revenue, I ended up with a debit balance sitting there, didn't I? 500,000, obviously, right? Okay, so I did what? I took that whole budgetary entry, and now I'm just putting in my revenues ledger the revenue debit part. Then what? Then I have actual revenue. I'm going to record my actuals over here, and I issue some fishing licenses. I don't know, whatever. And so I get some cash. When you receive cash, you do what? Debit it. And then what? We credit revenue, and I'm not going to call it actual revenue because I'm a grown-up. I'm a grown accountant, right? Only baby accountants call it actual revenue. It is what? Revenue. Right? I credit my revenue, and when I credit my revenue, well, look, they're talking baby talk too. I would just call it revenue, but what happens? We go ahead and we put the revenue in for 40,000, don't we? And when we put that revenue in for 40,000, do we end up with 460 left to go? So this government is tracking its revenue against its budgeted revenue, its estimated revenue, isn't it? So if somebody says, hey, how much more do we have to go before we hit the budget? About 460,000 more to go. We're just starting out, aren't we? So I can see throughout the year how I'm tracking against that budget. I don't know, a little bit later, next month or whatever, they issue some more fishing licenses. They debit cash for 50,000. They credit what? Revenue for 50,000. Now I got 410 left to go, don't I? So the debit to estimated revenue sits there as a placeholder against my actual revenue so I could track throughout the year to see where I'm going, right? Okay? In this class, I expect you to know this beginning of the year budgetary entry as we establish the budget. Debit estimated revenue, credit the appropriation. If we have a surplus, if we need a credit to make that journal entry balance, the credit goes to budgetary control. If I sit here and I have a deficit, the debit goes to budgetary control. With me so far? Okay, now what I'm going to do, I would take this highlighter, but it's the cheap version. I don't like these cheap highlighters. Okay? And why am I putting it over there? Huh? Because I'm stealing it? No. I said I don't like it. It's not government property. No. You think the government owns highlighters? They don't own any. I'm putting it over there so I don't write on the board with it. Then I'll destroy government property, and you'll report me. You'll go running into Gene Huang. He wrote on the board. Okay. All right. So anyway, what happens? We come with a regular pen. So what happens? We come over, and we have what? What was I talking about? Oh, this account budgetary control. And with this account budgetary control right now, in this example, we credited it for $50,000, didn't we? Okay, so I'm just going to go ahead and keep track of the balance in that a little bit as we go through the rest of this example. Okay, so we just went ahead and we have a credit balance in budgetary control. And you come over, and there's our entry there throughout the year. Okay, and then we get to our part where we're going to start to spend the money. So we've set up our revenues budget. We're keeping track of our revenue. Now we're going to start to spend some of that appropriation that we have, aren't we? Okay, so what do? When we order goods, we're going to make a journal entry by debiting encumbrance and crediting budgetary control for the encumbrance. So we're going to credit budgetary control. So budgetary control is going to have how much in here now? How much? 100,000 is sitting there, but we're debiting encumbrance. We're crediting budgetary control for having ordered these goods. Why are we doing this? We have a $450,000 appropriation, don't we? Right? Think about it this way. Let's say you went to the Tesla dealer, and you started looking at these. You guys see these Teslas, right? I mean, I can't almost not wreck my car when I'm staring at the Tesla going by me. And then I guess I better pay attention to my car because it's not driving itself, right? So what happens? You go over to the Tesla dealer, and you say, I want a pink Tesla. I want pink, okay? And I want it to have yellow doors, okay? Pink, except the doors, and I want it to have a stereo system that gets messages from the aliens, okay? And I want crushed velvet seats. You guys don't even know what crushed velvet is, huh? That's like, anyway. One time it was cool to have crushed velvet, okay? So you sit there and you say, I want all these things, okay? And so the guy says, okay, but that's going to cost you. No problem. Make me that Tesla. Pink, yellow doors, alien satellite, and I want crushed velvet. The guy has to look up crushed velvet when you leave. What is that? Oh, okay. So he puts that car together for you, okay? You come to the guy, he says, come on down, we got your car for you. It's going to cost you, $250,000, whatever, for all that special stuff we gave you. Oh, sorry, I spent all my money, I can't afford it. Is the guy going to be happy with you? Is he going to compel you to take that vehicle and pay him? How would he compel you to do so? He'll take you to court and get the payment, right? And say, hey, I made this car for this guy, and we had an agreement, right, etc. Okay, now put that same situation in the government situation. They have a legal authority of how much they can spend, don't they? And if they went and said, hey, give me all this stuff from, I want it made this way and that way, would the guy be amused if he couldn't pay them? If the government said, I don't have the money because I already spent my appropriation, would the guy think that was funny? The guy would say, no, you got to pay me. They'd be sued, and now the government would be legally forced to exceed its legal appropriation, wouldn't it? So to avoid all that mess, what the government does is when they order something, they set up an encumbrance, and that encumbrance serves as a placeholder against the appropriation to avoid the over-enthusiastic over-ordering of stuff, right? So that I don't order more than my appropriation. Okay, so that's what we do. We set up an encumbrance just like this, where we go ahead, debit encumbrance, credit budgetary control for this thing we're ordering, a new printer, whatever. And then what? That's an expensive printer. What is that thing? Must be one of them 3D printers or something, right? Okay, so what happens? We go ahead, we debit encumbrance, we credit the budgetary control, and then when the thing comes in, we reverse the original encumbrance entry for the original amount. Look at that. We debit budgetary control and we credit encumbrance, don't we? So since I've debited budgetary control, it can go back now to 50,000, right? Budgetary control kind of held that there for a minute, and now it's going back to the 50,000 in budgetary control. And the encumbrance is back to zero, isn't it? The encumbrance is back to zero. I don't need that anymore because I know my actual expenditure amount, don't I? And so I go ahead at this point and I debit expenditure. I credit voucher payable for the actual amount, don't I? So now I've shown my expenditure against my budget for the actual amount. Now sometimes students will say, well, wait a minute, it's a different amount. That's okay. It can be a different amount. Like, now look, it can't be wildly different. It can't be, oh, you set it up for 50,000 and here comes the bill for 10 million. You know, something is wrong with your budgetary process if you have that situation going on. But what? As long as we're keeping it close in the ballpark, this is giving us budgetary control, isn't it? So we debit expenditure, we credit the vouchers payable. Vouchers payable is like accounts payable. But in the government, we call it vouchers payable. It's like accounts payable. All a voucher system does, if this is a voucher, it's an approval process. So I'll have expenditure 1 sitting there. I'll have expenditure 2 sitting there. I'll list all these expenditures, and somebody is supposed to come through and look at those expenditures, say they're okay, and sign off on it so that we know that we have a voucher with that was a signed off expenditure. Did somebody approve that? Somebody at a high level approved that, or somebody with the authority to release that expenditure approved it. So then what happens? So then somebody like me, an auditor, comes along and I pull a sample of 100 vouchers and I look at those vouchers and I see that there was 12 of them that weren't signed. And so then I will say, we reviewed 100 vouchers, 12 of them weren't signed. The agency should ensure that there's appropriate signature authority over vouchers in the future, right? I come back the next year, I pull 100 vouchers, I find out that 10 of them weren't signed, so I write a report said there should be signature. I come back the next year, I pull 100 vouchers, I found that 18 of them weren't signed, so I can write a report that said they should start this, and then I do that for 30 years. And when I leave, the next person looks at those vouchers and said they're not signed, huh? That you would find some that weren't signed? Yeah, except I'm sort of describing 1920 to you. I mean, nowadays, there's probably a process where that's done internally, done electronically, I should say, in the computer. But yeah, I have a friend who works for the city, county of San Francisco. And she tells me that they don't sign off on things properly. And she's constantly after them to get all the signatures, and everybody hates her because she wants them to do all the appropriate signing off. So, yeah, I think it still happens. Yeah. It's human nature to avoid things like that, right? Tedious things like that. Okay, but anyway, what happens? We sit here, that's our vouchers payable, but we set up the expenditures, the important thing here, for what? For the actual amount, didn't we? Okay, now how did this help us to accomplish budgetary control? Well, now we have an appropriations ledger. And when we first put in the appropriation, we credited it, didn't we? Didn't we credit the appropriation when we got the legal authority to spend? It was a credit to appropriation, right? So it's a credit, and we have a credit balance in there, right? We order that very expensive printer, and we do what? We debit encumbrance, and when we do, our budget authority comes down to what? The amount that we have available comes down to 400,000, doesn't it? right? So if somebody runs in and says, hey, I heard we had $450,000 worth of appropriation in our equipment budget or whatever. We just found this beautiful machine for $450,000. We got to order it. What do we have to tell them? Sorry, you're too late. We're already committed for 50,000 of that. And what? I probably shouldn't use the word. I guess I could use the word committed. Remember we said that what? If the government has the highest decision-making authority, has locked us in to something, then that's going to be a committed amount. But also, if we have ordered goods to our specifications, that's also considered committed because we can't cancel the pink Tesla, right? And so that would also be considered committed amount. But again, I'm jumping to something more detailed than what I want to bring up here, which is what? We know that we don't have the budget authority to handle something that is more than $400,000 now, right? So aren't we controlling our spending so we won't overspend our appropriation? Now that sits there and as saying we have budget authority available $400,000, and then what? Then we come up and the actual amount comes in, doesn't it? The actual amount comes in, and when the actual amount comes in, remember we simply debited budgetary control, credited the encumbrance, so we reversed it out, didn't it? So that encumbrance is gone. For a split second, my budget authority comes back up to 450, doesn't it? For a second, but then I do what? I debit expenditure for the actual amount, and now I know that I only have $399,500 left to go, right? So if somebody comes to me and says, hey, I heard we had $400,000 left, and I was able to talk the guy down to $400,000 for that machine. Can we still get it? And I say, sorry, no, we only have what? We only have $399,500 left in our budget authority. And we just keep going like that throughout the year. When we order goods, we debit encumbrance, we credit budgetary control. When the goods come in, we reverse that, debit the budgetary control, credit the encumbrance for the original amount, debit expenditure, credit vouchers payable for the actual, don't we? Do we accomplish our budgetary control that way? Right? Okay. All right. Now, what happens? We sit there for the entire year going through this process, don't we? Now we come to the end of the year. Do we need our budgetary accounts anymore? We come to the end of the year. They covered us for this year, didn't they? We're going to get a new budget next year and start this whole process over again, aren't we? So if at the beginning of the year, this is what? Beg of year? What's that stand for? Beg of year? The beginning of the year, we debited estimated revenue what was it, 500,000? We credited appropriation for 450,000 with me so far? Right? We credited bud control in that example, right? Our buddy bud control for 50,000. That's the beginning of the year entry. I'm just repeating what we had seen on that earlier slide, right? You know where that came from? That earlier slide. Then what happens? Then at the end of the year, no, that doesn't look right. I'll do that in black. At the end of the year, we simply reverse that entry. We debit the appropriation for 450,000. We credit what? Estimated revenue for 500,000, right? See if I can squeeze it in. We credited the estimated revenue that says for 500,000, right? Credit estimated revenue for 500,000. Do I need a debit or credit to make this journal entry balance? I need a debit here of 50,000. That debit goes to what? Bud control, right? That's almost impossible to see there. But I debit budgetary control for 50. I debited the budgetary control for 50. Fix that. I can squeeze it in that little space there. I debit bud control. For 50,000. Right? Right? So my buddy budgetary control had a very interesting year, didn't it? Let's look how bud control, how it went through its year. Bud control, beginning of the year, I did what? Credited for 50, didn't I? Then when I ordered that stuff, I did what? I debited the encumbrance, I credited the budgetary control, didn't I? Then when the stuff came in, I debited the budgetary control, I credited the encumbrance, didn't I? And then at the end of the year, when I closed my budgetary accounts, I did what? I debited budgetary control for 50,000. Doesn't budgetary control have an interesting life? This 50,000. Hope this pen doesn't start that on me. The other pen I used to have, every time I took my finger off my pen off the screen, it wanted to flip the slide. Doesn't budgetary control have an interesting life? Okay, so budgetary control is sort of like a horse, isn't it? This is a horse. I'm not good at doing a mane on a horse, whatever they call that thing on a horse. Isn't this sort of like a horse? And then what? You load stuff on the horse. When you're done, you take stuff off the horse, right? At least the horse, you give it oats in between. The budgetary control, they don't do anything for it. They just take stuff off it. So it's like a dog, isn't it? That we just use for whatever, and then we take it off when we're done. Okay, so that's how budgetary control works. I'm just pointing that out because sometimes my students want to say, well, where does the budgetary control show up? Well, I don't see budgetary control in the financial statement. I don't see a budgetary comparison of budgetary control. Where's that? It's nowhere. It goes in. By the end of the year, it all comes out, doesn't it? Okay. Okay. Question. The burning question should be, are we really going to start chapter 4 now? And the answer is no, we're not. No, we're not. So I think we're going to chase that one class this whole semester, right? Okay, so we're still about one class behind the others, but it is what it is. Maybe next time we'll actually jump in and cover all of chapter 4. Okay, so for next time, there's no questions with this quiz because for this chapter because we're gonna get into them. Did we do the quiz for chapter 2? Oh, that's what we can do. Sorry, guys. I know that hurts because you thought you were almost gonna escape, and you did not. Almost escaped. Yeah, I'm going to try to do the chapter 2 quiz. Huh? We didn't do one either? Okay, good. So we got to get on that then. So let me close this. And practice. Practice exams. Quiz chapter 1 and 2, you say, huh? Okay. I had to do that, but okay, whatever. Okay, so let's go ahead and let's take a look at some of these questions. Screen froze on me? No. Okay, and let's just go ahead and let's take a look. And part of the entertainment, if you listen back to this thing, will be hearing me talk to the computer and say, why are you doing this? And then it stops doing it. Okay, but let's go ahead and let's take a look. And this first one from chapter 1. And if you're wondering, John, why are you saying chapter 1 if we're in chapter 1? There was a time where I had these all in one big file, but it started to get a little unruly for the students to figure out which were the chapter 1 questions. I mean, where the chapter 1 questions were and where the chapter 2 questions were. So I just pulled them out and put them all in their individual files, but I kept the original, calling out of the chapter because I didn't feel like going through and deleting it all. So anyway, Governmental Accounting Standards Board is the entity that sets accounting standards for who? What we're studying in this class? State and local governments, right? Okay. Okay, which of the following is the most authoritative source of our accounting standards? It's what? GASB. Okay. Which of the following has the highest level of authority for government? It is GASB. Which of the following organizations issue standards that are authoritative for state and local governments? It is GASB. Now, if you're sitting there saying, well, why are you doing this? Okay, we get it, GASB. All I did was I took questions from previous exams and stuck them in this file. So you know that you're going to get what? You're going to get a question asking you who sets the accounting standard. I'm not going to give you 5 of them, but you will get a question, right? Because that's consistently in the exam. Okay, in the exams. That's all these are. These are old exams, and I pulled questions from them. Okay? All right, number 5. The body that has been established to recommend accounting and financial reporting standards for the, federal government is the FASAB, the Federal Accounting Standards Advisory Board. GASB sets accounting standards for who? State and local governments, right? Okay, good. Come down. The Financial Accounting Standards Board has the responsibility for setting accounting standards and financial reporting standards for all not-for-profit organizations that are non-governmental and not business entities. Obviously, FASB does what? Sets the accounting standards for business entities. But remember, we said back in Chapter 1, FASB sets accounting standards for all private entities, including not-for-profits, right? Right? Now, they're calling out this non-governmental not-for-profit organization. What are they talking about? Well, can you think of a governmental not-for-profit organization? Has sort of a not-for-profit type focus, huh? Red Cross is a private not-for-profit. Did I say non-governmental? I'm sorry, yes. Red Cross would be a private non-governmental not-for-profit. Can you think of a governmental not-for-profit is what I thought to say, or what I meant to say, because we know that non-governmental not-for-profit are private entities, right? But could you have a public not-for-profit, a governmental not-for-profit? Huh? I'll give you a hint. Here it is. Governmental not-for-profit organization. San Francisco State is sort of a not-for-profit type of a situation as we're educating, but it belongs to the government, doesn't it? Okay, so if San Francisco State was preparing their financial statements, they would be under GASB's jurisdiction, wouldn't they? Okay, if we're talking about Golden Gate University, is that a not-for-profit organization? Yes, it is. Golden Gate's not for profit. I don't think they're for profit. Not what they were paying me when I was teaching there. No, I'm just kidding. I don't think they're for profit. No. Okay, I don't know. I haven't checked it out. I'm pretty sure they're not. Stanford. I know is not-for-profit. Stanford's a not-for-profit organization. It's private, though, isn't it? So when they prepare their financial statements, they follow what? They follow FASB standards, right? Now, you say, okay, so are we going to get into a whole raft of accounting standards for governmental not-for-profit? No. What GASB pretty much says to the governmental not-for-profit organizations is do everything the state and local governments do. So they simply have them follow the state and local government stuff that we're going to be learning in here, right? Okay? So if we're talking about what? All not-for-profit organizations that are non-governmental and business entities follow whose standards? FASB standards. Okay? Okay, good. Number 7. Which of the following is not an objective of financial reporting by state and local governments? To assist users in assessing the adequacy of systems and controls? Is that what we do with our governmental financial statements? Is that what we do with them? Huh? We do? Our financial statements are to assist users in assessing the adequacy and system of internal controls? No. These other things, financial condition, results of operations, those are what our financial reports do, don't they? Okay, so which of the following is not an objective of financial reporting by the state and local government? Not to assess the internal controls, right? Now, can you think of entities that have financial reporting that does contain an internal control reporting component to it? Publicly traded companies under their audit requirements, very good, under Sarbanes-Oxley. Section 404 of Sarbanes-Oxley says what? Says that the company will issue their own reporting on internal control, and then there will be an auditor that will speak to the internal controls of the entity and their reporting on the internal controls, right? So if you're a public company, you have to receive a report on your internal control, don't you? Right? Do state and local governments have such a requirement? They do not. State and local governments do not have to report a Sarbanes-Oxley type of report. Does the federal government do that? They do not. Federal government does not require that there be a report on their internal controls. So, why is that? Why is that? I guess that might be a reason. I have to be honest with you, I don't know why they don't have it. I mean, who do they think they are, right? They turn around and they pass Sarbanes-Oxley Act, the federal government does, that says you public companies will do this with cause, by the way, after what? After all the problems with Enron and WorldCom and all that kind of stuff. But they don't then take a look at their own financial house, which is not in order, and say, okay, maybe we should have to do the same thing, right? Now, in the federal government, at least there is a mechanism in place to do that if the agency wanted to request such an audit, there is the appropriate standards that would help with that audit. For state and local governments, they don't even have a specific mechanism in place at this time, although there's been some suggestion that they should come up with it. They do not have such a thing. Could the federal government compel state and local governments to get this sort of a audit over their internal control, with a report on their internal control? How would they compel them to do so? Well, tie it to the money, right? And they do require that there's an audit. They call that a single audit, where there's an audit of compliance, and that includes an audit of the financial statements. And all the federal government would have to do is say, and get a opinion on your internal control, right? Isn't that all they'd have to do? And that would help to improve the internal controls, state and local governments, as auditors look at that, and we would have the potential of a better use of public funds, wouldn't we? At the state and local level. And then all they have to do is look in the mirror to themselves and say, and you need to do that too. And what? We would get a better look at the internal controls, better internal controls of the spending of public funds there too. So I don't know why they don't do it, other than the fact that they're just lazy, I guess. They just don't feel like doing it. So they don't. Okay? Okay, good. And no one cares about the public reports of the federal government anyway. Nobody reads those. Okay, so let's go ahead and let's take a look at number 8. a comprehensive annual financial report prepared in conformity with the this is not, they say GASB recommendations, and it's really who recommends this? Who recommends these requirements? Not they are recommendations, but it's not GASB, it's who? GFOA is the one that says GFO. GFOG? Oh, I guess you better erase this now. I've messed this whole thing up. See, why can't PowerPoint have the pens like this? It's the same company. Just put the pens and stuff right there for me so that I can not have to do that thing where they disappear and reappear. It's not that distracting for you to see the pens up there in the corner, is it? Okay, so anyway, what happens? The GASB, not the GASB recommends, but who recommends? GFOA recommends, don't they? GFOA? Okay, they're the ones. Government Financial Officer Association recommends that in the CAFR we have what? We have an introductory section, a financial section, and a statistical section, right? Remember that? We actually scrolled through, was it San Jose's? Or was it San Francisco's? San Jose. Okay. Okay, good. Number 9, which of the following should be included in the financial section of the comprehensive annual financial report? And remember, we did what? We picked up the MD&A. We picked up the basic FS. And the notes there too. And then we had what? What's in this bottom box? RSI, and we stuck all that into the financial section of the CAFR, didn't we? Okay, so the what? The financial section includes the basic financial statements and the notes there too. The transmittal letter is in the intro section. Tables and charts showing demographic data is where? In the statistics section. A description of the government is in the MD&A. I don't know. I'm thinking that would be in there, so this is kind of a screwy question. D shouldn't be there because that would confuse you because you know that there's a description of the government in the MD&A, isn't there? So that's not the best question. Okay, let's go ahead. What time does this class get out? 55? 3-4 minutes? Okay. So why don't we do this? Why don't you continue to go through this quiz? I kind of gave you a jump start. Continue to go through this. Go through Chapter 2 quiz. We'll start with that next time. And then we'll go into Chapter 4. And hopefully we'll get through most of that. Okay? All right, guys. Have a good weekend. And I will see you next Friday. I won't be. I won't get down here. I have to sit in a committee meeting for something else, unfortunately. Okay, I'll be right here. Are you going?